Hello, my name is Brock Vandenberg and I'm the President and Chief Operating Officer of TaliMar Financial. We are a hard money lender here in San Diego, California. We've created a platform for trustee investors to locate, to underwrite, and invest in trust deeds. Visit our website at talimarfinancial.com. Click under the Investor tab to available trust deeds, and we list all the trust deeds that we currently have available. This video is part of a series of educational videos we're offering trust deed investors. Today I'm going to talk to you about some of the common mistakes trust deed investors make. Over the last 10 years, since I've been investing in trust deeds, I've made many of these mistakes. So hopefully I can stop you from making a couple. One of the most common mistakes that trust deed investors make is not understanding the underlying collateral that is securing their trust deeds. Here at TaliMar Financial, we focus on non-owner occupied residential properties. The reason why we focus on non-owner occupied residential properties is that they're the most liquid type of real estate asset. If I had to foreclose on that property, I know that I could sell that residential property relatively quickly because there's a large number of buyers that are looking for that type of asset. I compare that asset with, let's say, land, which I consider one of the most illiquid assets. You can imagine there's much fewer buyers looking for land than there are residential properties, which is one of the reasons why I typically stay away from using land as collateral for my trust deeds. The second common mistake that trust deed investors make is not understanding the purpose of that loan. Here at TaliMar Financial, we focus on what we call fix and flip loans. The purpose of that loan is the buyer is using the funds to acquire the property and renovate it for a future sale. So I understand what the purpose of that loan is. If a borrower were to come to me and not have really an understanding of why they needed the proceeds, I could be caught in a relatively tough situation, as they may be pulling those funds for either personal use and or just to pull the funds and walk away from the property. So understand what the purpose of the loan is for the borrower. The third most common mistake is not understanding the repayment plan of the borrower. Again, here at TaliMar Financial, we focus on fix and flip loans. So the repayment strategy is simply to sell that property at a future date. However, there are situations where we do residential income properties and on occasion use commercial real estate as collateral. In those cases, I truly want to understand how that borrower is going to pay us off. In most cases, that borrower is using those funds to either update the property, upgrade the property, maybe doing tenant improvements, which will increase the value of that real estate, and therefore they can go out and get a traditional loan, which would pay us off in the future. Number 4, one of the most common mistakes trust deed investors make is what I call chasing yield. When I started TaliMar Financial back in 2008, there were very few lenders out there that were financing fix and flips, which meant that I could get a relatively high yield for the funds that I was lending out. In addition, I can lend out a relatively low loan to value. Today, as more capital has entered the marketplace, the yields that I can charge have dropped substantially. One of the common mistakes people make, however, is in order to obtain those yields that they were getting in the past, they're taking more risk. Now, that may work in the short term, but most likely in the long term, when there is a market dip, your trust deed will be what we call out of the money. So the value of that asset is less than the outstanding balance of your trust deed. So what you did by chasing yield in the long term has lost you money. I do exactly the opposite. I'm willing to take a lower yield to keep a less risky, more safe trust deed investment opportunity. I know that in the future, as the market slows, less capital flees the market, I can go back and start charging the yields that I was getting. But that's because I had the capital available to lend out. So don't chase yield. If you find that the yields that you were getting for the structures that you felt most comfortable with, or loan structures you felt comfortable with, are dropping, just go with the market. Go with your gut. Keep your trust deeds safe. The fifth common mistake is borrower capability. Now, we here at TaliMar Financial, again, fund fix and flip loans. So I want to understand what is the capability of that borrower to complete the project. Obviously, the types of loans I structure for first-time fix and flippers are going to be a little different than experienced fix and flippers. But that also goes for borrowers that have income property or commercial real estate asset. What is their capability to, number one, manage that real estate asset, maybe manage those tenants, manage the income generated from those properties, and then their capability, if they have a loss of income, any reserves that they might have to continue to make payments on that loan. So it's really important that I understand the borrower capability on the loans. Those 5 mistakes are some of the most common mistakes trust deed investors make. If you don't make those mistakes, investing in trust deeds over the long term will be a very profitable venture for you. For more information about investing in trust deeds, feel free to visit our website at talimarfinancial.com, or feel free to give me a call, 858-613-0111 extension 1, and please check out our other educational videos.